Ensuite, nous avons intensifié nos efforts pour mobiliser.
Second, we have stepped up efforts to engage with a wide variety of stakeholder groups beyond our traditional partners. Our goals are to reach Canadians directly and increase public knowledge of and participation in our activities in order to broaden understanding of our work and to build trust. A number of activities to engage the public are upcoming or already underway. These include an online campaign to involve the public in the 2021 renewal of our inflation targeting framework. And we have also just concluded a campaign inviting the public to nominate an iconic Canadian to be featured on the next $5 note.
Chair and Senior Deputy Governor. Oh, I have to go back to English, sorry.
Thank you very much.
Let me stop there, Chair, and Senior Deputy Governor Wilkins and I would be pleased to take your questions.
Thank you. And again, thank you both for coming, and thank you for those remarks, Governor Macklem. The lineup for the first 6-minute round will be Mr. Polyev, Mr. Fraser, Mr. St. Marie, and Mr. Julian. The floor is yours, Pierre.
Congratulations, Governor, on your appointment. Your predecessor testified before this committee not long ago, and when asked about the possibility of inflation, something that many Canadians are worried about given that the bank has created almost $400 billion out of thin air in the last roughly 100 days, he replied that inflation would be a good problem because we know what to do if it arises. What would you do if inflation turns out to be higher than the central bank originally expected over the next year or two?
Governor.
I recognize that there is some concern about the extraordinary actions the Bank of Canada have taken. During the 2008-2009 global financial crisis, the U.S. Federal Reserve embarked on a aggressive strategy of quantitative easing, large-scale asset purchases. And at that time, there was concern that that would cause inflation in the United States. It did not cause inflation in the United States. In fact, it prevented disinflation and kept inflation reasonably well anchored on their 2% target.
Sorry, it's just that we don't have a lot of time. The question is, what if there is an unexpected rise in inflation? What would you do to combat it?
If there is an unexpected rise in inflation, and I don't anticipate that that's going to happen, but if that were to happen, we have all the tools, as Governor Poloz indicated. Well, we can raise interest rates.
There you go. Raise interest rates. Now, we have, as of 2018, according to the IMF, $3.56 of debt for every dollar of economic output in this country. That number is surely higher today. And that, of course, includes household, government, and corporate debt. In the G7 only, Japan is higher than Canada when you take into account household, corporate, and governmental debt. How much of an interest rate hike could the average Canadian household sustain before they would be unable to pay their mortgages or other credit market debt that they hold?
Just to interrupt for a sec, we will give you ample time to answer, Governor. We've got 2 hours here, so we'll give you ample time to answer. Go ahead.
Well, I want to stress that our focus is on supporting the recovery. The Bank of Canada has lowered interest rates to the effective lower bound of 25 basis points. We have embarked on a strategy of large-scale asset purchases, and that has a dual purpose, partly to restore, one purpose is to restore good functioning in our debt markets. The other purpose is to lower interest rates out the yield curve.
Sorry,
and we're very so.
Mr. Poloz, the governor has at least 20 more seconds to equal your time, even.
For
and
now,
this is a crucial issue. So go ahead, Governor.
For now, and for the foreseeable future, we're focused on providing the monetary stimulus and delivering low interest rates to support the recovery. And that is lowering the debt service costs that households face, and companies and governments.
How many households would become insolvent with a 2 percentage point increase in interest rates?
Governor?
These questions are extremely hypothetical. We have no intention of raising interest rates in the current circumstance.
Of course not. That's why I'm not asking about the current circumstance. I'm asking about the medium-term circumstance, sir. You've admitted that if inflation rises unexpectedly, that you would raise interest rates. Those were your words. You said that. And we need to, as Canadian parliamentarians, to know what that would do to households. How many would become insolvent if you had a 2% increase in interest rates?
The biggest risk to Canadians coming insolvent is not having a job.
Right.
The biggest risk to Canadians not being able to repay their mortgage is not having a job.
Right.
The government of Canada has delivered an extraordinary amount of support to help bridge Canadians through this. A monetary policy has lowered interest rates to reduce the interest rate costs that Canadians are facing.
All right. So
and that is the best contribution we can make to getting Canadians back to work, which is the best thing we can do to improve.
So, Mr. Chair, sorry, we're well over
insolvent
in the response time. So it doesn't sound like you have planned for the prospect of future interest rate hikes, and doesn't sound like you've modeled out what impact they would have on households. I want to return to a paper you wrote in 1995 about government debt. And you said, in particular, higher debt levels require higher tax rates to be sustained, and taxes affect economic activity by driving a wedge between the price the sellers receive and the price the buyers pay. The wedge imposes an efficiency cost on the economy that is larger the higher the taxes are. In labor markets, for example, most studies find that the effect of higher taxes is to reduce desired labor supply, and the disincentive effects of taxation are larger the higher marginal tax rates are. In other words, higher taxes, less jobs. Higher taxes, less work. That's what you wrote. I'm wondering if your recent appointment has changed your mind and your perspective on this, and if you've reversed yourself in order to align with the high debt and high tax policies of this government, or if you've retained the view that you had in that paper.
Thank you. That'll end the questions. Mr. Governor, you have about a minute to answer. Go ahead.
Well, fiscal policy is the purview of the Minister of Finance. What I wrote as an economist in the 1990s.
Or the Bank of Canada.
I stand by it. I stand by what I wrote. I would remind you, though, that the situation in the 1990s was very different. In the 1991-92 recession, Canada had a very very high debt situation, and as a result, the government was unable to provide the kind of stimulus and enforce. And of course, coming out of it, there was a large fiscal consolidation. Today, the situation is very different. We are reaping the benefits of starting from a very good fiscal situation, and the government is in a position to provide needed stimulus.
Okay, thank you, Mr. Fraser. 6 minutes or thereabouts. We do have ample time, and I want people to be able to have the time to clearly articulate their views. This is an important subject. Mr. Fraser.
I'll do my best to give the witness time and focus on real world examples where possible. Look, there's a point I want to pick up on from my colleague, Mr. Poloz, and it seems as though he wasn't listening to Mr. Milligan's, Professor Milligan's testimony before this committee, who pointed out very eloquently that it wasn't government decisions that led to increased cost to Canadians. It was the fact that we have a global pandemic that created a certain cost. And in fact, the government's response is probably one of the best ways to mitigate the social costs of that pandemic. From there, we heard testimony from other economists who suggested that the federal government is perhaps best to positioned to incur some of the debt that this virus has caused in order to, again, mitigate those social consequences. Your predecessor, when he testified, did make the same point that, if anything, this pandemic is likely to have a deflationary effect, and that if there was some inflation, that might actually help the economy in these scenarios. But coming back to the point that Mr. Poloz led on, which is really the risk that a higher interest rate could potentially have. I'm curious, you've mentioned that you don't believe there is a risk at present of that kind of an economic consequence. But why is that? Are there strategic risks we should be turning our mind to that could cause a sudden and unexpected hike in the rate of inflation, or more importantly, for the purpose of this line of questioning, the rate of interest?
Well, I think the bigger risk is falling inflation and even deflation.
Mm-hmm.
And for two reasons, we are more concerned about the risk of deflation than inflation. First of all, deflation is particularly harmful to an economy, particularly an economy with high levels of household indebtedness, because the real value of people's debts goes up and their ability to service those debts goes down. And that's why I was saying they're more likely to become insolvent in that situation. Secondly, we're already in a position with our policy rate at the effective lower bound of 25 basis points. Interest rates across the yield curve are already very low, so there's only so much monetary stimulus space available. And so for both those reasons, you want to really guard against falling inflation and particularly deflation. We're starting across Canada to see the containment measures coming off. And with that, supply is being reopened, and we're starting to see people be called back to work. We're starting to see people make purchases, but given that we've lost roughly 3 million jobs, we've got about 290,000 of those back. So we're still down 2.7 million jobs. You can expect that the purchasing power, the confidence of Canadians is going to be severely impacted by this. And that is going to reduce demand more than supply, which will put downward pressure on inflation. And so our actions are really designed to bring inflation back to target. And the way to do that is to support employment and output growth.
So I would like to come back, if there's time, to the issue of whether there are risks we need to be worried about on the other side of the equation. But for now, I have a limited amount of time, and I'll pivot in my line of questioning. Of course, you were heavily involved with the expert panel on sustainable finance, and you made a point that I think is important in your new role about the independence of the bank. Obviously, helping transition towards a greener economy and a more sustainable economy is something that was necessary, in my view, before the pandemic arose. But I'm curious, there's been an enormous coordination between OSFI, the bank, and the federal government in the pandemic response. On the issue of sustainable finance or economic growth more broadly, how can we continue to see that level of coordination that does not interfere with the independence of the bank, but allows Canada to position itself most competitively to take advantages of the opportunities that were flagged in the expert panel's report on sustainable finance?
Well, I'm glad you've seen our report. I will underline at the outset that when I chaired that panel, I was Dean of the Rotman School of Management, and together with the other expert panel members, we delivered that panel to the Minister of Finance and to the Minister of the Environment, and it's really up to them now to decide what to do with those recommendations. I do think that responding to climate change is going to take whole of government, whole of economy effort. It's going to take, it's going to take the public sector. Importantly, it's going to take the private sector. Ultimately, the private sector does most of the production in this economy, and they have a very important role to play too. I'm going to ask my colleague, Deputy Governor Wilkins, to say a few words on the bank's research and strategy